Welcome back. You're watching Stockwatch with me, Julieta Televi, and joining me this evening to take your stock-related questions are Zwelakhe Mnguni from Benguela Global Fund Managers and Willem Oldewage from Nitrogen Fund Managers. If you'd like to send questions, please email stockwatch@bdtv.co.za or on SMS. That's 41392 is the number. Willem, Zwelakhe, good evening to you both. Zwelakhe, if I may start with you tonight. It wasn't a bad day on the JSE. Added about 0.6% on the all-share index. Rand was a little bit weaker, and it's interesting that we weren't maybe completely destabilized by weaker than expected GDP numbers out of China. Did you think that maybe that would have had more of a negative impact on our market?
Yeah, I think it did have a bit of a negative impact on the iron ore players, but I don't think it was as bad as one would have thought. I think the whole resources sector still held up quite well, largely because of the gold sector. So if you strip out the gold sector, you probably see that there was a bit of pain in some areas of the market.
Willem, but that is quite interesting because if you looked at the GDP figures that came out from China, the production side of the economy is looking okay. It was the retail sales that were quite disappointing, and that I would have thought would have affected, shares like Tencent and then Naspers and Prosus or Richemont, for example. What did you make of that and the interplay with our own market?
Sure. So I think that's a very good point. Tencent was down about 2% this morning in Hong Kong. Luckily, or not, it's not luckily, but Naspers is seen as a rand hedge. So as the rand weakens, Naspers in rands strengthens.
Okay.
So in dollars, Naspers stayed level, which sort of offset the 10-cent side. And then we did see some weakness from Richemont, also coming from the Burberry and Swatch results earlier this morning. So overall, I think the fact that the JSE is 60% rand hedged is the reason we sort of survived the Chinese poor GDP figures.
Okay. The other two interesting news items of the day for our own markets were two buyouts. The small cap sector is it's been claimed thick and fast by either, I suppose, owners or raiders, but in this case, actually both owners, so Sasin and Bell Equipment. And actually, there's a question on Bell Equipment, Zwelakhe, and maybe we can talk more broadly about the deal. But if the viewer says, I'm a holder of Bell, so obviously he's feeling quite happy today. Should I sell into the open market or wait until the payout?
Yeah, look, I think probably the share price has already rallied to some extent on the news. And I'm not sure exactly what is the date, the closing date, but essentially you have to weigh up the date against the opportunities that you could miss out on. So if the price is rallied and there's very little premium left on the current price, I would take the price and maybe reallocate that capital instead of waiting.
Yeah, because it's 53 Rand is the offer, and it spiked up to 49 Rand today. Willem, you're nodding. Are you in agreement?
Yeah, there? I think Zwelakhe completely answered that correctly. There's about 6% left from 49 to 53. So if you think it's going to take maybe more than 6 months for the deal to settle, I'd suggest you sell or sell exactly. And if less, I think 6% is not bad for sort of a half-year annualized return.
Yeah.
So that's up to the investor. But ultimately, these deals, if you look at similar deals in the past, take about 4 months. So considering the fact that he's going to pay a transaction cost on the sell, and it should probably settle much quicker. There's no change in control. It's a very simple transaction. The IA Bell company that's buying the company already owns 70%. So there's a large chance that this would be successful and timely. So if the investor doesn't see any sort of easier or like very, very high quality opportunities, there's no reason to sell sort of into the initial flurry.
Okay. Then a follow-on question, which I guess is the inevitable question. A viewer says, 2 founding families taking out minorities delisting today. This has been spoken about for a while now, and it seems the dominoes are starting to fall. Which other companies are likely to follow suit? So, who do you think are obvious contenders to be bought out because they just haven't had much love on the JSE? And I wonder, Leila Fourie must be sweating a little bit because it just does seem as if there are going to be more of these.
No, look, I think the environment, in terms of our market, I think the environment is right for these kind of transactions. And by the way, there's been a number of attempts to take Bell out many years ago. Was one of the companies that I covered as a young analyst. And in Bell's case, they never work. But I think the current environment is basically favorable to opportunities where management could take companies out. And I think it's because we've had our companies being ravaged by the tough economic environment, and you've had interest rates being high, and we look set to move down the rate curve, and that might actually be supportive of environment where you can buy the assets, and then as the economy performs better, you can actually do better. So I don't have specific names, but I think the environment is right for that kind of thing.
Okay, so the environment is right. Willem, do you have specific names? Is it? Yeah, it's not necessarily a slam dunk who would go. But if you had to give it a best shot,
I definitely wouldn't give a name, but I think there is a trend that's noticeable from all these mid-cap takeouts. It's generally a very small free float, sort of 20 to 40%, and a very sort of small company, so market cap between maybe 1 and 5 billion. Most of these sort of very high premium buyouts have been in that sort of categorization. And then you have to look at sort of the income line, because being listed in the JSE is a cost. So if you looked at Bell's announcement today, they made it very clear that they just didn't find it economically viable to stay listed. It made more sense to buy out the company, because the earnings accretion is so large if you sort of have lower audit fees and no listing fees. So that's the sort of company you'll be looking at, like a small cap with a fairly small free float, which management can then buy out. And they're generally very well priced. I think Bell was trading at a 4 times earnings, like price earnings multiple, and the offer's that thick. So the share's up 50%, but it's a fair deal for the purchaser and in a liquidation event for the minority holders.
Yeah, I mean, it is quite an interesting, and probably you could use AI to put in some of those inputs, and you could kind of narrow down a list. So that would be quite an interesting exercise. I don't know if you think EOH would be another contender, and I ask that because a viewer has sent us a question about EOH, just asking, the viewer says the average price is R3.37. They ask about holding for a period of 4 years. Do you think it'll get back to the average price? I don't know why they ask, why they would say 4 years or 1 year or 6 months. Zwelakhe, firstly, do you think EOH's share price is heading back up to above R3 anytime soon? Secondly, do you think EOH could be a contender for a bigger player to come and buy it?
Yeah, but I'd probably say no to both questions. I think EOH still has got some work to do to get itself out of the mess that it had in the past, where acquisitions had contributed to debt burden and also earnings that were overstated. So I don't think they are out of danger as yet. So I would probably, if I was asked or forced to speculate, I'd probably say you're lucky to get anything more than the interest rate on EOH in the next 2-3 years. And then in terms of could it be a buyout, I would think that if there was a bigger player who sees the opportunity to maybe take out the head office costs and basically justify the transaction on that basis, it could happen. But I think it's quite a difficult thing when the business has been tainted by some governance issues. So even if somebody wanted to buy it for the reason I said, I think it would be difficult to justify it from a corporate governance point of view, because you don't know whether the numbers are true or not.
Yeah, although you hope that they've put everything, I mean, it seems as if they've put all the bad past behind them. Willem, your thoughts on whether this is also whether you should stick in if you're way below your average entry price. This is the conundrum for a buyer. Do you stay in or do you cut your losses?
I have to agree. I think in terms of a buyout target, I think if it was going to happen, it could have happened already. If you look sort of Adapt IT was bought over by Valaris a few years ago, and this has been sitting sort of at a fairly low price for a long enough time. So I think the decision is more versus a better opportunity than versus whether EOH would sort of have a random potential catalyst, a buyout or some sort of windfall. In terms of the sort of operating environment, South Africa does look better than it has 2 months ago. So if you do have the time and you do sort of believe the GNU is going to last and there'll be South African growth, I think they can capitalize on that, and there is potential for that. So I don't think it's necessarily sort of give up on your initial investment call, but I don't think you should just sort of hope for a buyout or some other catalyst. I don't think it's going to shoot the lights out. I think if you could beat cash, that would be a fairly good result.
Okay, I hate to use the verbal segue of shoot the lights out to shooting, but there is actually a question that's come through, and I'm going to end this section with it. And a viewer says, can I please have the panel's view on the shooting of Donald Trump in the US? How will it affect the market and global markets in general? So will it affect the market insofar as it actually may usher in another Trump presidency, which a lot of viewers, a lot of commentators seem to be expecting as a result?
I get a sense that he might get a bigger majority than what he would have had he not been shot at. And I think that the areas that would benefit, probably the war complex would probably suffer, but you might find that he will drive the local economy, so the tech sector will probably do a lot or even better under Trump. Purely because he's so focused on bringing jobs back into the US. He's also focused on all these, he's got sanctions against, he's the guy that started sanctions against China. And he'll probably push on that, and that may be favorable to the US economy. So probably a bit more inwardly focused businesses, but also businesses that are able to do transactions outside the US and import that revenue into the US. So yeah, I think more the warmongers would probably suffer under Trump.
Which is interesting. Willem, your thoughts on which sectors might flourish under a Trump presidency and whether that would be good for US markets in general?
Sure. So generally Democrats are more socialists and Republicans are more capitalists. So I think there would be a sort of shift in sort of business favorability towards the US. And Trump has been historically incredibly vocal against China. So I think if your base case is that Donald Trump's going to win the US elections, you'd probably sort of underweight China tech and sort of overweight US tech. And then globally, today, I think it was interesting to see just some small safe havens, things like the dollar, Bitcoin, gold, just on the fact that there was an attempted assassination of a former US president. So I think it does sort of add some risk to sort of the spot market. And I think long term, definitely sort of US focus, less Europe, less China, and sort of focus on sort of US industry in terms of investing for that change.
Yeah. Okay. During the break, we were talking about Sasin, and I realized that maybe I haven't fully understood the Sasin offer. And, we were talking about Bell laughing about the fact that it's been trying to delist itself for years, but finally the Bell family have actually made a decent premium. But Willem, you were saying that it's maybe a little bit more complicated with the Sasin offer than just selling your shares into the open market if you are a Sasin holder.
Yes, exactly. So Sasin Holdings is being taken out by Sasin Capital. And the offer is only made for up to 10% of the outstanding shares in Sasin at 30 Rand. But there will still be a delisting event after. So if you hold Sasin and you cannot hold an unlisted security, if this deal goes through, you would have to either hope that only 10% of shareholders elect to take the cash offer, or you might end up with an unlisted stake in the holding company. And that's about the Sense announcement, it's about a 3-to-1 ratio. So there's about a 27% float that needs to be bought, and there's only a 10% sort of cash buffer for that portion.
That's really weird. And if you don't want that, you don't want to be ended up in an unlisted vehicle. It puts minority shareholders in a very awkward spot, doesn't it?
Exactly. So I think it's worth waiting for the circular. Because there's a large chance that obviously there are some sort of discrete shareholders that aren't allowed to sort of communicate to the market or trade that have already committed to not taking the cash offer.
Yeah.
Because that has happened before, sort of having an unlisted potential in on a delisting. But this specifically, as it stands, is not a certain sort of 30 Rand per share if you own Sasin.
Okay. So we're lucky you're not known for keeping stum about events that may be prejudicial to shareholders. If you were a shareholder in Sasin, what would be your first sort of port of call? Find out where you stand.
I would wait for the secular, but I would probably say that if they take it out, they need to do it a clean break. I mean, you can't put shareholders in a situation where they don't get their full payout. Otherwise, they could get put into a situation where they might have to sell at an unfavorable price. I don't think it's a viable option for investors. But I think maybe they'll clarify that in the secular.
Okay.
As Willem says, I mean, to offer 10% or to avail 10% cash, I think makes it difficult.
Yeah. Okay. All right. Well, we'll wait for the circular. Hopefully, there'll be a bit more clarity there. Then, on to further questions. A viewer says, I missed the ShopRite bus at 221 Rand. I'm floored to see the 296 Rand share price now. Have I missed the buying opportunity or can I still enter? Willem, what do you think?
Personally, I think you might have missed the bus and you've sort of called it correctly. And I think if there are other options, you can maybe look at something like Woolies, because if you do some of the parts on that, you see the grocery business looks sort of fairly well priced inside it. Sort of you have to sort of think of a multiple for Country Road and for the clothes in South Africa and for the financials business. But I think there's other options rather than sort of going for something that's already rallied that generally doesn't work well.
Zwelakhe, is that a trade you'd be comfortable with, or would you rather?
I would say it depends on what your time horizon is. I think ShopRite is a very good business. I think they are innovating. They are, and you can say maybe they like it that Pick n Pay is also struggling, and we saw that Pick n Pay is given a big incentive to basically get Sean Summers to deliver a turnaround. But I still think that I'd be better off in ShopRite in the food retail sector. I'd be better off in ShopRite than in other players. So I'd still hold on if I've got a horizon of 3 years or longer. They get in their execution very well. They are able to offer competitiveness in a tight economy. I think long term they're good business.
So you'd still buy them even at this lofty price?
Yeah, I'd say for a 3-year holding period, I'll still buy them. I'm comfortable with the quality of the business it is, and I'll still buy it at these levels. Might pull back and maybe I might average down, but I still feel that it's a good business that you can hold for the long term.
Okay. Then talking about the long term, there's a viewer says Anglo or BHP Group for a 5 to 7 year view. Okay, so firstly, Willem, Anglo or BHP, and also would you buy them for a 5 to 7 year view? Because you got to do a bit more trading with the resources stocks than necessarily with other shares.
Yes, so 5 year they've become much more similar than they used to be. So BHP is sort of mainly iron ore and then sort of a third copper, whereas Anglo still has a lot of things they're sorting out. They're going to try and get rid of their coal businesses. They're going to try and get rid of their diamond business. They want to delist Anglo Platinum, or sorry, not delist, unbundle Anglo Platinum. So out of the two, sort of wink, wink for my stock pick later, I definitely choose BHP. I think they're a better quality management. They're very prudent. And I think it's a much simpler investment case at the moment than Anglo is.
Okay. All right. So I'd be curious to hear about your stock pick. Zwelakhe, just on BHP, if you've got a big iron ore component, do you think that is going to be the metal that's in demand for the next 5 to 7 years? Because China's had its period of industrialization and you're going to see a lot more recycling of metals. Okay, copper would be important, but would you have the same thirst for iron ore that you would have had in the last 2 decades? And taking market cycles into account?
Look, I think about it this way. So I think you look at iron ore as a cash cow. They are the lowest cost producer at BHP, that is, in that sector. And they basically can take the free cash flows that they generate from iron ore and redeploy them elsewhere at very good returns. They've been known to do that. They are a very focused management in terms of operating low cost of production assets. So if I say 7 years, I'd probably feel safer in BHP. I think Anglos in the short term might do better because there's a self-help story. But I think if you think long term, I'd probably feel a lot more safer in BHP. I think they will take the cash flows and redeploy them very profitably.
Okay. All right. Then a couple of quick questions before we get to your stock picks. Can the panel please give their opinion of Nike? It's dipped over 20%. Should one sell or buy the dip? Willem.
Buy the dip. Nike's a well-established multi-billion-dollar global brand that missed sort of sales figures that were already sort of onerous, and they have so much sort of going for them now. You know, we have the Olympic Games next year. We had the Euros. What else can I think of? Tennis is like Wimbledon just finished. I mean, like there's a lot of Nike sort of advertising happening, and even though they missed sort of on a single number, I don't think that does anything for the long-term prospects of the company. I think it's a very high-quality company at the moment at a fairly good rating. So I think it's definitely more of a buy the dip than sort of a panic and sell.
Okay. I mean, it's had a very poor quality year on the stock market, but okay. So you would buy the dip. Zwelakhe, would you similarly give them the benefit of the doubt?
Definitely. I think they're down over 30% year to date. So despite that, their disappointing performance recently, I would still back them for the long term. The brand that has succeeded over many other brands. We know brands like Fila and others that have Reebok that haven't made it up to this point. They've managed to succeed. So I believe that there's something strong and good about Nike, that they're doing well. So I'd be in favor for long term.
Okay, and then a quick property question. The viewer says, I'm interested in adding a property fund to my portfolio. What's the view of the panel on Sirius or Burstone property funds as a buy on current prices? Burstone, I always have to remind myself, is formerly Investec Property Fund, well, one of them. Willem, if you had a choice, which would you pick?
I'd pick Sirius. I'm more familiar with the company and the management team and sort of the UK exposure. And then they've been doing like capital raises. I'm sure you'd have seen, I think last week they did a book build, and then about a year ago they did one as well. And those have been paying very, very good investment rates on those, and sort of active and engaging. And then just it's a nice moment to invest outside of South Africa when the rand strengthens. So I think getting some UK exposure while the rand's strong is not a bad idea in terms of sort of those two options. That's mainly why I pick Sirius.
Zwelakhe, do you have a different view? Burstone has stuff in Europe, Western Europe, and also Australia. I mean,
I'll take Burstone in Australia. I think it's if I'm not mistaken, the dividend yield is over 10%. I mean, it's operating in a good, stable environment, and I think they will probably do well. There is no concern around, the economy falling apart in that part of the world. So I'll certainly externalize my money through that one.
Okay, all right. So, the viewer could maybe divide the property fund into two picks. Okay, but getting to your stock picks this evening, Zwelakhe, I'll stick with you. What are you going for?
Yeah, I'm going for Adobe. I think the stock has rallied fairly much since the beginning of the year, but I still think that there is potential for it to actually do a lot more creative offerings on the back of this artificial intelligence capabilities that they are acquiring like everybody else. I think there's still scope for them to lower the cost of delivering those creative offerings for the marketing people in particular. And I would go for Adobe for the long term.
Okay, great. So Adobe for you. And then Willem, I don't know if it's BHP that is your stock pick or if a different player in the commodities sector.
No, it is the BHP group, and sort of as Zwelakhe sort of was kind enough to sum up for me, they have the advantage of sort of a high quality company which they can use as an acquisitive group. So we sort of saw their takeover attempt on Anglo. They can always do that again. There are quite a few copper miners globally that are trading at very low valuations. And then in terms of their current commodity split, obviously we're all saying it's 70% iron ore, 30% copper. But as the prices change, they would become a copper group. If copper went to 12,000 or iron ore came to $90. But the fact that they're so low on the curve on iron ore means they're the last loser. Iron ore price is going to fall, and for everybody would close down before they also would sort of start taking sort of negative free cash flows from that business. And then on top of that, it's a very good valuation. They haven't had sort of a crazy year. I think it's about a 10% forward P with an 8% dividend yield. So it's a high quality, easy sort of company to invest in with real potential, real catalysts. Specifically, it seems like from their side, like looking at copper for the long term.
Okay, gents, well, lots of food for thought. Thank you very much for your time this evening. Nice to chat to you both. Zwelakhe Mnguni is from Benguela Global Fund Managers. Willem Oldewage is from Nitrogen Fund Managers. And up next, we have the close. Stay with us.